Advantages and disadvantages of IPO for companies. 3. Disadvantages: needing to comply with strict information disclosure requirements. Public companies are required to disclose a wide range of information to the public, including detailed financial statements, profit figures, tax information, and other sensitive data. This information is made available through regular filings with regulatory authorities, such as quarterly and annual reports, as well as immediate disclosures of material events that could affect the company's stock price. While transparency is generally beneficial for building investor trust, the disclosure of sensitive information can be exploited by competitors. Competitors can analyze the company's financial performance, product development plans, and market strategies to gain a competitive edge. For example, if a company discloses plans to enter a new market with a specific product, a competitor might rush to launch a similar product first or undercut the company's pricing strategy. Moreover, the process of preparing and disclosing this information is time-consuming and costly. Companies need to maintain a dedicated team of financial professionals, lawyers, and compliance officers to ensure that all disclosures are accurate, timely, and in compliance with relevant regulations. Any errors or omissions in the disclosures can lead to legal consequences, including fines, lawsuits, and damage to the company's reputation. Bearing pressure from the public and shareholders. As a public company, the spotlight is constantly on its performance and actions. The public, including customers, activists, and the media, closely scrutinizes the company's behavior. From its environmental and social practices to its treatment of employees, any negative news can quickly damage the company's brand image and erode public trust. Shareholders, especially institutional investors, exert significant pressure on the company to deliver consistent financial results and maintain or increase the stock price. They often have high expectations for short-term earnings growth, which can force management to focus on meeting quarterly targets rather than pursuing long-term strategic goals. For example, a company might delay investing in research and development or cut back on employee training programs to boost short-term profits, which could harm its long-term competitiveness. Shareholders also have the right to vote on important matters, such as the election of the board of directors, executive compensation, and major corporate transactions. This can lead to conflicts between management and shareholders if their interests diverge. Activist shareholders, in particular, may push for changes in the company's strategy or management team, which can be disruptive and costly. High listing costs and increased administrative and compliance burdens. The process of going public is expensive. Companies incur significant costs, including underwriting fees, legal fees, accounting fees, printing costs for the prospectus, and marketing expenses to promote the IPO. These costs can amount to millions of dollars, which can be a significant burden, especially for smaller companies. Even after listing, the administrative and compliance costs remain high. Public companies are subject to ongoing regulatory requirements, such as maintaining internal controls over financial reporting, conducting annual audits by independent auditors, and holding annual shareholder meetings. These activities require substantial resources and can divert management's attention away from core business operations. In addition, companies need to establish and maintain an investor relations department to communicate with shareholders, analysts, and the financial community. This department is responsible for organizing investor conferences, answering inquiries, and providing updates on the company's performance. The cost of maintaining such a department, including salaries, travel expenses, and technology tools, adds to the company's overall expenses.